Welcome to the Asino Traders Group. This is our 30-day stock market challenge, and we are on day 18. So, a part of our weekly trade plan, we always talk about winning and losing traders and what separates us from being a consistent trader to a beginner trader or even experienced traders. Sometimes make this mistake of holding on to a trade, hoping that it will break even. We talked about how people get caught up in the tick-by-tick battle instead of looking at your trade plan, looking at your signals, looking at your rules and criteria for exiting a trade and getting out, and emotionally becoming attached to that trade and holding on until we finally break even. So, what we are here today is to continue our study of Bollinger Bands. This is the second part of our Bollinger Band study. Last time we talked about the potential uses of Bollinger Bands. We talked about, first and foremost, we use Bollinger Bands to identify periods of high and low volatility. Now, when it's bands like we have here in the bottom left of this picture, or even here it might be a little bit more visual, when the bands begin to spread open, like the mouth is opening like in a Pac-Man, that is when the volume is coming in the stock, the volatility is picking up, and that is a period of high volatility. However, when the bands begin to narrow and they become tightened and they come closer to that moving average, that is a period of low volatility. We also use Bollinger Bands to identify support and resistance. You can see that in this uptrend, the resistance was walking up here with the band, but more importantly, this simple moving average, whatever it is, became support. And when the stock came and touched it, it basically went back up to the band, came back down, went back up to the band, came back down, and went back up. And when it finally violated is when this uptrend finally ended. We also use Bollinger Bands to confirm our trend. We can see here as we are heading up in an uptrend, when we can say that we feel good about this uptrend as long as the stock is walking the band, hugging, staying right along the band. And when it begins to pull off, that's when you want to tighten your stops and make sure you're prepared for a potential reversal. And finally, we're going to use Bollinger Bands to give us possible trigger signals for entry and exits out of our positions. So that's kind of where we're going to focus today, but we want to review what we talked about last time. So what is this walking the band? I mentioned that in the last video and I got some questions about that, so I wanted to spend a quick moment about that. And walking the band is basically when a stock is trending. And an uptrend, as we have right here, the stock begins to rise and stay right along the Bollinger Band. It is when we begin to pull off that you need to tighten your stops. It doesn't mean the trend is over, but you need to be careful that it might be over. And this is when we're, and you can see that we're no longer getting that confirmation of this uptrend. Similarly, in the downtrend, the stock will hug right here along with the band, come right on down, and when it begins to pull off, that's when you want to tighten your stops. Now again, what we want to talk about now is what to look for with Bollinger Bands. We want to talk about these trigger signals. And last time we talked about Bollinger Band squeeze plays. But also we have what are called Bollinger Band double tops and Bollinger Band double bottoms. Now, last video we talked about this calm before the storm. We talked about the Bollinger Band squeeze play. This is where a stock is consolidating, it's channeling. And remember, when these bands begin to tighten and get closer to the moving average, this is a period of low volatility. Now, this may sound weird, but during this period of low volatility, the momentum is actually building up. And this stock is ready to pop. Now, we don't always know what direction it's going to pop, but we want to play that breakout. And as the stock continues to go sideways, this momentum is building up. And then again, as these bands begin to spread open like they're getting ready to open their mouth, we now have a great entry into the stock. So today we want to introduce the Bollinger Band double tops and double bottoms. And basically, it's no different than any chart pattern with a double top and double bottom. It says that they happen on the Bollinger Band. But what we're really looking for is that, again, when these stocks are pushing down and when they are walking the band and when they begin to pull off, we want to see if it does form that W pattern by coming back down to the band and pushing up. When you see a double bottom or you see a double top, you should trade cautiously. We could see the trend ending. You need to prepare for the stock to reverse. Now, the stock may continue in the initial trend, but you need to be aware that we're pulling off of the bands, and we need to be prepared for a potential reversal of trend. So let's go ahead and take a look at some examples. So here we are looking at Cummins CMI, and we can see the stock pushed down right here, made a low, pushed up, came back down. This does qualify as a double bottom and went up. Over here we have a better example where it pushed down, went back up, another double bottom, went up. A better way of looking at double bottoms and double tops is simply when a stock makes a push and pulls away from the moving average back towards the pulls away from the band, the Bollinger Band, and comes towards the moving average, and then makes another attempt. So you can see it pushed up, made an attempt to come back down here to the bottom, failed. That's a signal to say, hey, it couldn't make a new low, time to get out. Same thing, we made it push down, came up, and when we kept pushing down, we never made a new low. Now notice, what do we also have here? We have consolidation, we have a squeeze, we have a period of low volatility. And we'll go over a little bit here. And notice, there it is, notice right here. I believe this was earnings. But you can see here's also an example of Bollinger Bands being support and resistance. And then pop! Our bands are open, it's up, down, spread apart like we're ready to open our mouths to eat. And that during this period of low volatility and consolidation, the momentum built up, and then look at it go. Actually goes a little bit higher. And again, this is a good example of we get in the here, and what would be our indicator here? Well, the band spread here, we're on the daily chart, so we wouldn't have got in here. We would have said, okay, if we make a new high, get in the stock. So as it's consolidating here over to the right, we wouldn't have got in the stock. We would have put an alert above the high of today. So realistically, you probably would have got in the stock right around here using the moving averages as our stop. So we probably would have got around 57, went right on up, came back down, did not violate the moving average, and went back up. And then now is where we obviously, but once this happens, we want to tighten our stops, and now we do get that violation, and we should be out of the stop. Now what CMI actually does at this point is a lot more of this consolidation. But what I want to get to is I guess, is over here, consolidation, band spread apart, and we came down, and we already showed you that, you know, using the daily chart, you would stay inside the trend. So let's look at a couple other ones. Here we have Goldman Sachs, and we have a good example of a double bottom here. The stock came down. First of all, we have this. Stock rallied, came back, never was able to push back down to the band. That's a double bottom, get out. But let's say you stayed in it, pushed back again, was not able to make a new low. You had two signals here to get out of the stock if you're in for a put. Once we made the second, actually third bottom here, that was your signal to get out. The band spread here, and we go up. Once we violate the moving average, it's time to get out. But what we should notice is that once we came down and failed to make a new high, and tested the moving average, we only got a little bounce. Again, that's another signal to get out of the trade. Okay, let's look at one last one. Here we have Google pushing down. But again, you can see retrace back to moving average, unable to make a new low. That's a double bottom, triple bottom. These are all your cues to get out of the stock, tighten your stops, protect your profits. Then it goes up, and eventually we take off. Now let's look at the top side here. And when we look at the top side, you can see we pushed up, made a new high, came down to the moving average, and never even attempted to make the double top, never attempted to push back up. This was another signal to get out of the trade, tighten your stops. So when we're referencing these double tops and double bottoms, we're really talking about the stock walking the band. When it pulls off, we need to see it go up and make a new high, or we need to tighten our stops and prepare for a reversal. I want to finish by again saying that when you're using your indicators, whatever indicator and time frame you use to get into the stock, you need to use that to get out. So here we're on a daily. So if I'm using a daily to get into the stock, I need to use the daily to get out. So here, when on the NASDAQ, when the band spread here and we push down, I would stay in the trade because we haven't followed the moving average, and we push down again. Same thing here on the S&P 500. The band spread here, we pushed down, came up, and again, on the daily chart, we never really violated. We should still be in the trade. Let's take a look at when. Band spread apart here, we pushed down, never violated. So now if you're day trading, you might have gone out, but again, using our charts, using the same time frame, band spread apart, we're open, but never violate that trade. So that concludes our study of Bollinger Bands. Hopefully you guys got something out of it.